Good morning or good afternoon, or good evening, whenever you get time to watch this video. It's Joel Seach here, Principal Advisor from Apprise Harpel Group. I hope you are keeping well and the start of the financial year has got off awesomely for you guys. I just wanted to give a quick update in terms of the current market environment. The last video we did back in around April, May was just the latest with the Trump tariffs and what was going on there with the volatility around the world. And today was more around the market diversification and the Vanguard charts that come out each year that I always like to do a bit of an update video on. It provides a really good perspective over a timeline with what diversification does and talks a bit about the different asset classes that make up a portfolio generally. And also an interesting snippet at the moment with the V-shaped recovery that we saw off the back of those Trump tariffs that occurred and are still sort of unfolding as we go as well. And just more broadly, a bit of a market update because the market's forever moving, it's forever changing, and what we've seen of late is a bit of volatility, but some really strong years that have occurred off the back of some of the AI and tech boom and some really big tech companies and growth stocks pushing the market along. But today was really about just chatting about what diversification is and what it does to your portfolio, which makes up your overall investments and returns over time. So the first one I wanted to really start with today was the Vanguard Patchwork Quilt, which talks about the different asset classes, both defensive and growth aspects that make up a portfolio generally. So if I grab the mouse here, we can put in the snippet here. So the importance of diversification, and we've got from 1996 here all the way through to 2025. Now, if I pick the highlighted color and we say green for growth aspects, we've got Australian shares, Australian listed property, international shares, international listed property, US shares, and international shares there. So these icons here are essentially your growth icons. So the circle and the circle down here. Now, if I pick a different color and call it red for the defensive assets, we've got Australian bonds, which is classed as a defensive asset, cash here in the little gold square, which is a defensive asset, and then the square unfilled or maroon unfilled color, which is the international bonds color. Now, if we take a bit of perspective and we look for this color here, and we look for the gold here, and we look for the square unfilled down here, we can get a pretty good snapshot to see where we're sitting over a period of time and picking out those different asset classes. So we can see the gold is generally falling in the bottom half of the patchwork quilt along here. So we can see generally our gold is falling in this section of the graph or the chart. The maroon circle is also falling generally in this bottom half of the graph down here. Yes, we have some outliers that bolster up here, as we do with the gold cash as well. And then the last one is the maroon unfilled, which is a little bit harder to see, but we see it sort of pops up a couple of spots down here, generally again falling a lot in the bottom half of the graph down here. And it's got a couple of little peaks up the top. Now, if we flick back over to the green again here, the highlighted green, we can see our circles and our squares filled, which is our property and our growth stocks, and also our diamond here in the blue, which is our US shares, are generally hovering in this top part of the graph here. Now, it's not always the case, but it's generally hovering in the top part of the graph as an overview. So it's a really fascinating case study to see that the actual best performer over that period was US shares, and we can see the worst performer over that period was the gold, which is cash essentially, which is the bottom part of that graph. So having a weighting is important to give us some weighting to growth assets, which are always going to be more volatility. However, they will generally provide a better outcome of return over time, as opposed to our defensive stocks our defensive assets, I should say, down here in the red, that generally make up the bottom part of the quartile or the best to worst performers over a period. But as we saw, cash was the best performer once, whereas if we just look at an example of US shares, 1, 2, 3, 4, 5 and 6 periods of time, US shares was the best performer. 7 periods of time, I missed one. And then, yeah, defensive and so on fall into that line. But it's not always the case, but generally if we look at a period of time, it really helps us get that perspective of what those investments do, which is really cool to see, and a really fascinating case in point in terms of that graph down there. Now, the other graph I wanted to share with you guys today was just the Vanguard chart, which I've got just sitting in here. So the Vanguard chart is a really cool one because you can get a really good snapshot over a period of time from 1995 all the way through to 2025 up here as well. So it's a really cool little graph here. We can see, looking at that same time horizon, I think the patchwork quilt was 1996, but it shows us having obviously some money invested back here, $10,000, what that would be worth up 30 years time, 214,000 of US shares at a return of 10.8%, Australian shares, international shares, so on and so forth. But the interesting thing is purely just to see what the markets do over that period. So we can see here back in 2000 was the dot-com boom, and then we had the terror attacks. In 08-09 we had the European crisis and the GFC that occurred, so we had a bit of a glut after that period. And then from there we had a pretty good period or a patch of growth over that time. This one here we had in COVID, where we saw the market take a big hit and a fairly quick correction back up again, which was interesting there. And then more recently we can see the Trump reign with the tariffs coming in. We can see that V-shaped recovery, and this is only up to June 30, and we're probably back up at around here now, where the markets have really kicked in over that period. So I guess when we sort of look in here and we do a snapshot in as a close snippet, and we see, okay, well, when we're going in nice and close, we sort of feel those big hits fairly largely, because we're seeing that market move quite dramatically. However, when we scroll it back out and we look over perspective over that period of time, which is always the cool thing about this graph, we can see that slow ascension over that journey of 30 years that makes up this chart here with your asset classes and what it's doing over that period. Yes, it goes up and down over time. However, over a journey, it will continue to have that ascension up that mountain. And it's obviously the analogy I've used before, which is just the yo-yo going up and down. The boy walking up the hill with a yo-yo. The market is the daily yo-yo going up and down. And that hill is that ascension or that undulating hill over time, with the markets continuing to improve. So it's a really cool chart. I thought I'd share that one with you. Again, I like to do that each financial year just to talk about the perspective of the markets and what they do over that period. Obviously, we won't have ups forever. It has its ups and downs, but generally speaking, the investments and the companies that make up these shares and property trusts, they generally make money. They make profit and growth, and if they don't, they get gobbled up, or they get merged and they turn into bigger companies, and the best companies continue to do well, continue to make profits, which then returns to your portfolio as well. So hopefully that chart today really helps to give some perspective on everything, as well as the patchwork quilt. If you have any questions, as always, feel free to reach out to us around these charts, or if you'd like a copy of them, more than happy to send them out to you. Good ones to show the kids or the grandkids too, because it's a pretty cool way of explaining the market and what things do, and keen to hear your thoughts on that as well. We'll catch up for reviews as we go, but look forward to hearing from you, and please feel free to share any feedback you've got. We'll chat to you soon. Bye for now.